credited for any and debited for any freight in, and also it will be credited for purchase returns and purchase discounts. Number 3, whenever we sell inventory in this system, the cost of goods sold will be debited and inventory will be credited for each sale. So we call it perpetual. Perpetual means continuous. So we have a continuous accounting for inventory. Every sale and every purchase or every sale return or purchase return will affect the value of inventory in our books. That's why we call it perpetual, because we account for inventory at each and every purchase or sale. So now this is the perpetual system. With regard to the periodic system only updates the amount or the account of inventory and cost of goods sold only at the end of the period. That's why we call it periodic system. So purchases of merchandise are debited to account called purchases. This is a temporary account, and ending inventory is just simply determined by a fiscal count. So at the end of the period, we will have the following figures. We will have a beginning inventory, we have purchases, and we have ending inventory. And and based on these, we can calculate the cost of goods sold. So we only know the value of inventory on hand and the cost of goods sold only at the end of the accounting period in this periodic system. Okay, now to understand both of these systems, I will skip these simple exercises in the PowerPoints, and I will try to solve with you example 1, example 2, example 3, and example 4 now in the exercise workbook that I provided with this chapter. So we have 4 exercises that describes the treatment of these things. Example 1 will show how to account for purchases and purchases related transactions using a perpetual system, the continuous updating for inventory. And exercise 2 will account for purchases transactions using a periodic inventory system. Then in exercise 3, we will see some sales transactions, and yes, we will see some sales transactions, and we will see how to account for them using a perpetual inventory system. Then for the same transaction, we will use a periodic inventory system. So now let's check these examples. We have 4 transactions. First one, purchase 33,000 of merchandise on account from Manoli Company, FOB shipping point terms 210 and 30. So as you can see, we made a purchase for inventory that has a value of 33,000, but we purchased that on account, and we have a discount, a credit discount of 210 and 30. So 210 and 30 means that if we paid within 10 days, we will get a 2% discount of the amount due. So based on the perpetual inventory system, I have to update inventory account at every purchase or purchase returns. So simply here, because I made a purchase of inventory, so inventory account will be debited, and I will credit accounts payable because it's on account. So simply the purchases amount is 33,000, and the accounts payable will be 33,000. Now let's check the second one. The second one paid $1,500 cash as a freight on July 6 purchases. So we paid a freight. Freight, it means shipping cost, like transportation cost, related to ship the inventory from the seller to the buyer, which is us. So the cost of inventory includes any cost that we need to make the inventory in our stores and ready for its intended use. So freight in, it will be part of the cost of inventory. So means this one, the freight in cost will be a debit for inventory and a credit for cash. We paid this in cash. So I will debit inventory by 1,500 and I will credit cash by 1,500. So the freight that we need, that we pay to make inventory, to get inventory and make it available in our stores, it will be part of the cost of inventory. So it's not only the purchase price of inventory will be included. Okay, let's have a look to July 8. On July 8, received a credit of 2,500 for merchandise retained. So as you can see, for a certain reasons that is not mentioned here, we retain some of this merchandise. So by returning merchandise, for sure the inventory value, the inventory that we have on hand, it will be decreased. So inventory will be credited, and also the liability related to this transaction will be decreased. So now accounts payable, the liability will be decreased by 2,500 and inventory will be decreased by 2,500. Now let's do the last transaction. Paid Manoli Company in full. So we paid Manoli Company the amount owed. So now the question here is how much we have to pay. So we have a liability. The liability that we have to pay is 33,000, but because when we returned some of the inventory, the liability decreased by 2,500, which means now the liability balance is 30,500. But if you remember, we have a 210M30 credit discount. So based on this discount, if we paid within 10 days, so the purchase was on July 6, so we have up to July 16 to get the discount. So we paid on July 15, so for sure we will get the discount. So we don't need to pay 30,500. We will get also a discount. This discount is 0.02, which is 2%. 2% of the amount due, which is 30,500. Okay, I calculate this. It has an amount of 610.